So, years ago, we met with a second-generation owner who inherited her folks' small manufacturing business. For the sake of anonymity, we're going to call this owner Alice. And in our first face-to-face meeting, we could see that Alice had lost complete control of her business. Her business was generating almost $6 million in annual revenue, year after year, yet somehow they were losing money hand over fist. Happens more than you think, folks. The cost of running her business was totally out of control, and she had no idea why. So like so many other business owners we've worked with, Alice was overcompensating for rising business costs and lack of control by focusing on driving top-line revenue. But no matter how many new clients she brought through the door, the company struggled to get ahead. Rather than take responsibility for how she was running the business, failing to control costs and margins, she blamed the economy, her employees, and anybody else she could. Hi, I'm Lou Mosca, Chief Operating Officer of American Management Services here in Orlando, Florida. Before we move on, we think content like this is beneficial to those operating a business. We'd appreciate you clicking the like button and sharing this with your connections on LinkedIn. Don't forget to subscribe to us on YouTube and connect on LinkedIn to get more content like this. Now, back to our friend Alice. Alice had ignored serious profit leaks and didn't put in any effort to find the source. Her main problem, outside of taking responsibility, was she lacked an ironclad fiscal and operating plan. Many of the owners we deal with, if not all of the business owners we work with, want one thing more than anything else: to increase sales. We're not suggesting sales aren't essential to growing your business, but we stress the importance of maximizing margins and profitability along with driving revenue. Of course, having a clear financial and operating plan for your business to increase profit is crucial. This starts with writing out a business plan and quickly moves into developing a plan for profit. If you need help with writing out a business plan, we have a video just for you right here. A plan for your business and profit? While your business plan may include potential profit, they vary. Let's discuss this further. Most, or many of the owners we meet with estimate sales, usually optimistically, then go by department to figure out the cost of those sales before arriving at the bottom number, the profit. Profits become the leftovers from sales. That is what is referred to as residual profits. We advocate putting profits above all else. Small business owners must look at what their profit margin should be based on a realistic estimate of sales, and then bank that money at the beginning of the fiscal/financial year. This method is called predetermined profit. If your business is realistically set to earn 5% on $10 million in revenue, then $500,000 should be moved to the side. The remaining $9.5 million would be or should be used to run the business. We can't stress this enough. You need to think realistically. We like to break this down to pennies. So for every dollar your business generates, how many pennies should be profit? Per the example, 5 cents is skimmed off the top for every dollar, and the remaining 95 cents is put back into the business to pay for your operations and overhead. It sounds like a simple explanation, but truly complex in practice. We have a video explaining the concept here. So let's go back to our good friend Alice. Of the $6 million in revenue Alice's company generated, our analysts determined that profit should be at about $600,000 or 10%. That means for every dollar of revenue, 10 cents should be put aside, should be banked. So the remaining $5.4 million is the money Alice has left over to operate a business, and she absolutely cannot spend more than the $5.4 million. So, with our help, she then implemented airtight departmental budgets. Department heads who go over budgets are held accountable, and those who manage to save money will be and have been rewarded. To sustain profitability, Alice underwent changes herself. Her guesstimates and passive management style were put out to pasture. When it comes to a predetermined profit plan, there's no room for assumptions. So throughout our consulting phase, we worked with her and her team to ensure she kept a close watch on margins and cash flow. she found leaks in her purchasing department, habitually overordering the most expensive paper stock, even as demand for the fanciest stationery dropped. So in that first year, we grew confident that with a clear profit goal in mind, Alice would find more ways to save on cost and even exceed her 10% profit margin. Exceed it. So for instance, her offices were way too big. Staff and supplies could easily manage a space a third of her size. Having negotiated with her landlord and relocated to a smaller space in the same industrial park where the company was based, she was able to shave almost $35,000 per year off her operating costs. Again, with a predetermined profit plan in place, the excuse for failure diminishes quickly. Along with a proper business plan, your financial and operating goals are laid out by the numbers at the beginning of the year. Employees have their goals written in black and white, which you can refer them to from time to time. Folks, it's all about discipline and holding yourself and your staff accountable for profits and adjust quickly. So without a doubt, having a predetermined profit plan is the key to success. By having this plan in place, you can track your progress and ensure that you are on track to hit your targets. This level of accountability is essential for any and all size businesses. So I'm going to tell you, if you do this, there is no reason why your business shouldn't be able to improve and keep profits high, just like Alice is today. So if you think you're in the same boat as Alice, give us a call at 800-743-0410 anytime. Don't forget, please don't forget, like, share, and subscribe. Look forward to speaking with you.